In this video, I'll explain exactly how to earn a steady stream of income with dividend stocks, and we're starting right now. Hey guys, Elliot here. So if you've dabbled with stock investing, chances are you've heard of dividends. They're defined as a sum of money paid regularly by a company to its shareholders. In other words, if you hold a dividend-paying stock, you will earn cash proportional to how much stock you hold. This cash comes out of a company's profits and is typically paid out to the shareholders every quarter or sometimes monthly. So theoretically, you could build up a nice juicy portfolio and eventually get paid enough dividends that you may be able to live off them. Now, if this sounds rather awesome, that's because it is, and you will find thousands of videos on YouTube proclaiming how you too can roll in the cash and just spend your days lounging on the beach. In fact, the premise of FIRE, or Financial Independence Retire Early movement, is centered around on building up enough income-producing investments that you can just, well, retire early. But how much can you really make here? Well, not to pour some cold water on the concept, but the dirty little secret of dividend investing is that you need to invest a lot of money before the amount of dividends you will receive will come close to funding an early retirement. As an example of just what you can possibly earn, let's take a look at Coca-Cola. It's perhaps one of the best known and widely held dividend-paying stocks, but more importantly, it's fairly typical as far as dividend payments go, and I would even say it's on the more generous side, so certainly a good example to study. Here's a screenshot of the Coca-Cola stock as seen through the TD Ameritrade interface. As you can see, it currently trades for $61.18, and here's the dividend breakdown. For every share of Coca-Cola stock that you own, you will get $1.94 per year, or about 46 cents per quarter. This equates to 3.17% of one share of stock, and this percentage is referred to as the yield. Now, the yield can fluctuate as the stock price varies day to day, but the actual amount paid out will be fixed unless, of course, Coke's board of directors decides to raise or cut the dividend. So as you can see, we have a bit of a problem here. Let's say you have a job that brings in $60,000 per year gross, or $40,000 per year after taxes and other deductions. You hate your job and would like to replace it with dividend income. Now, you will be taxed on your dividends, which for your income level, and assuming your shares are qualified, will be around 15%. Therefore, in order to actually keep $40,000 in dividends, we'll add 15% for taxes, so you need to actually receive $46,000 in dividends. With some basic arithmetic, you can calculate that at the current dividend rate, you will need to hold 23,711 shares of Coca-Cola, which at the current price is equal to $1,450,638.98. And that is just to replace a $40,000 net income. In other words, just enough to get by on, and certainly not live like a rock star. And keep in mind, this is a fairly good dividend. Walmart pays an annual yield of just 1.38% and Apple just 0.56%. Ouch. So yeah, most people don't have $1.5 million to buy enough Coca-Cola stock to replace a $60,000 salary, and the fact remains that unless you're already a millionaire, you're not likely to get rich quick off dividend investing. But wait, don't throw your phone, iPad, computer, or whatever you're using to watch this video into the bathtub quite yet. There are ways to speed up the process and earn sizable income with dividends. After all, that is the title of the video, and I always deliver what I promise. The best way to accelerate dividend earnings is to invest in high and ultra-high dividend-paying stocks. No one said that the 1%, 2%, and 3% yields are your only choices, and there are plenty of other dividend-paying stocks which deliver 7, 8, 9, or even higher dividend yields. However, there's no such thing as a free lunch, and you do have to ask yourself, why are these dividends higher? After all, since dividends come out of a company's profits, they're probably not going to want to give away more than they'll bare minimum to keep investors interested in their stock. As it turns out, along with increased yields comes increased risk. Stocks that pay dividends of 7 to 10% and higher do so to compensate investors for a certain amount of instability and volatility their businesses operate with. However, these risks can be managed by carefully researching the companies you're planning on investing in and weeding out those whose risk is unacceptably high. This is called ultra-high dividend investing, and it's something I've been doing for years. Not all stocks that pay high dividends are equal. Some you really need to stay away from, but many others do represent solid businesses and solid business models. They may be in a risky industry or business sector, but they do an admirable job of navigating and managing that environment. Your job as an investor is to do your research and find these companies. Your reward is much higher dividends and a quicker path to your financial goals. How much faster? Well, as an example, if a company's dividend stock costs the same $61 as Coca-Cola's but has a 9% yield instead of 3%, it will now take only 8,363 shares to reach the same goal of replacing your $40,000 net income. income, and it'll cost you a more manageable $511,648,000. Still a large sum, but way better than $1.5 million and quite doable if you have a good paying job, live frugally, and are able to save and invest a good portion of your income for 5 to 10 years. So if this all sounds interesting, what sort of company should you start looking at if you want to invest with high dividends? You're simply not going to find these kinds of yields among the Walmarts and Coca-Colas of the world, and you need to look into a whole different class of investments you may not have been familiar with. This brings me to the main point of this video. Here are the categories where you should be looking for these ultra high paying stocks. This will just be an introduction, and look for more future videos on how to analyze these stocks and specific recommendations. The first category to tell you about is covered call ETFs. They are funds that write and sell covered calls against stocks in their portfolio, and some examples include ticker symbols Q Yield, X Yield, R Yield, JEPI, and NUSI. These ETFs write calls against NASDAQ, the S&P 500, and the Russell 2000 indexes, as well as some combination of these, and they pay dividends in the 9 to 14% range. The second category to tell you about is closed-end funds, or CEFs. These are mutual funds that are closed-end, which just means they don't accept new funding once they get going, which allows them to use leveraging and other risky financial tools to increase income. Some examples of CEFs include the Aberdeen Fund, ticker AOD, PIMCO Dynamic Fund, ticker PDI, and the Brookfield Fund, ticker RA. These funds pay dividends in the range of 8% to 14%, and if you want to learn more about them, I actually have a video dedicated to CEFs with a link in the description below. The third category to mention is business development corporations, or BDCs. These are organizations that invest in distressed companies as well as non-distressed small and medium-sized firms. In all cases, they help these companies turn their business around and grow to a stable level. BDCs typically buy up a significant stake in the companies they are assisting and profit when the shares of these companies appreciate. Examples of BDCs include Ares Capital, ticker ARCC, Barings, ticker symbol BBDC, and Main Street Capital, ticker MAIN. And they typically pay dividends anywhere from 7 to 13%. The fourth category to mention is real estate investment trusts, or REITs. REITs are synonymous with commercial real estate, as they essentially buy up commercial properties and make their money by charging rent. They are an excellent investment option for just about any investor, and the easiest way to get a foot into the commercial real estate without actually buying properties. Examples of REITs include National Retail Properties, ticker NNN, Realty Income, ticker O, and WP Carry, ticker WPC. REITs generally pay a bit less, with 4 to 6% being typical, but on the plus side, you do get decent share appreciation as well. The fifth category is energy stocks. Now, these aren't just your typical oil and gas companies like ExxonMobil. While they are certainly worth holding, the dividends paid are not very high. The ones I recommend focusing on are what are called midstream partners. These are companies that are in the business of storing and transporting the oil and gas. Think pipelines and storage tanks, not actually drilling for oil or selling it on the retail side. There are two reasons midstream partners are such good investments. For one, they pay excellent dividends, with most being in the 7 to 9% range, and the other is price stability. Midstream companies make money regardless of the cost of oil and gas, with both being notoriously volatile in price. However, whether they're up or down, midstream companies make the same money, as the oil and gas still needs to be transported and stored. Some examples include Enterprise Product Partners, ticker EPD, Magellan Midstream Partners, ticker MMP, and Oniak, ticker OKE. Well, there you go. The secret to a high dividend portfolio is investing in a whole new set of investments that you may not have considered before. Covered call ETFs, closed-end funds, business development corporations, real estate investment trusts, and midstream energy corporations. You still need to do your research carefully, as among these categories, as with anything really, there are good and bad investment choices. I will break each of these down further in upcoming videos and tell you exactly what to look for and what exactly is in my personal portfolio that returns approximately 17% in dividends and appreciation. In the meantime, please do research these yourself. If nothing else, you'll expose yourself to some new and interesting investing ideas and possibly make some money along the way. As always, thank you for watching. Please do like and subscribe, and I will see you all in the next video.